Aloha folks, thank you so much for checking out this video. If you are new to my channel, my name is Mark, Mr. Dividend Investor. In this video we are going to talk about a company that a viewer requested for me to take a look at. So if you're interested in a company and you want me to take a look at it, just drop the comment and tell me what company you want to take a look at, and I'll check it out for you. As always, please remember this is not financial advice. This is just me sharing. For those of you that are just new to the channel, hopefully you like this content and subscribe, and don't forget to hit the notification bell so you don't miss out on any of the videos that I put out. Without any more delays, let's take a look at this company. So the company I'm looking at is CARR. The ticker symbol is CARR. It is an American multinational heating, ventilation, and air conditioning. They do refrigeration and fire and security equipment. So if you want to take a look at the website, just check it out. As you can see, they do a lot of the home air conditioning filter system. They also do companies as well, and indoor quality. So they're also partnered with Russell Wilson. So definitely check that out if you're a big fan of this guy, or if you're a big fan of the company as well. So let's take a quick look at some of the overview. So you can see 21 key data points, 20 billion sales, adjusted operation profit of 13%, free cash flow of 1.9 billion. They are in 160 plus countries. And then here's what they do: fire and security, aftermarket in Asia. You see that in the stuff. And then what I didn't realize is they do digital and technology, like cloud-based performance, like A-Bound, Linux, and all that stuff. So they are a global leader in health, safe and sustainable and intelligent building and cold chain solutions. So if we go a little bit further, you can see some of their CAGR. So there's a 10% in the health and wellness, sustainability, 9%, 15% in the digitalization and then growth middle class and all that stuff. So yeah, definitely go check it out. Get a little information about this more. If you go to Yahoo Finance, you can see 52-week range, 34. The high is 57. At the time of this video is about 35. And then you got your PE ratio is at 11. Forward dividend yield is 0.6. And then if you look a little bit more, you can see the earnings. You can see 4 beats in the last 4 quarters. You can see the revenue on 2021 and then compare it to 2020. 2020 is 17 billion and then 2021 is 20 billion. So you can see a good increase in the profit. And then the recommended trend, mixture of holds, buys, and strong buys. And then you got your recommended rating between a buy and a hold. And then the price target is at 46. Currently it's at 35, so you're pretty much getting it below the average. Now let's take a look at the comparison. So I wanted to compare it to the S&P 500. So the blue one is S&P 500, and then the other one is CARR. So you can see based on the 2-year comparison, global carrier has been doing a pretty good job in terms of the last 2 years. If we look at a little bit more in the Yahoo Finance, who are the top institutional holdings, you can see Vanguard, and look, that's a pretty big amount of shares they hold. Capital Research Global also holds a pretty good amount, as well as BlackRock, State Street Corporation. You can see they hold pretty much a big chunk of it. And then the mutual funds, you can see these are the whole parts of it where it's in there. So moving along to Nasdaq, based on their analysis, they rated as the consensus rated as a buy. There's about 20 of them, and then here are your 20 firms that said that it's a buy. So people like Citigroup, Cohen and Company, Morgan Stanley, Wells Fargo, Zach Research. And then if you look further, you can see their high is at 47, the average is 43, and then the low of 36. Now if we swing to sticking at Nasdaq, I wanted to look at the dividend history. So you can see 2020 is the most recent one all the way up to 2022, and then you can see they've been increased it for the past 3 years. So again, PE ratio is about 11, dividend yield is 1.66, and then your annual dividend is about 60 cents. Now let's take a look at Simply Safe Dividend. Based on their dividend safety score, they rated as borderline safe, which is 60, and then you got your dividend yield of 1.7. Market cap is 30 billion, which is a large cap. And then you can see the key metrics in here. Payout ratio is about 24, which is very low for most companies. Forward payout ratio is about 25. And here you can see dividend yield is only 1 year without a reduction. But then the latest is 25% in December, which is very fast. So you can see, not a lot of history right now. So eventually, I could see this going up in the next couple of years. Payout details quarterly in the months of February, May, November, and August. Annual payout is 60 cents per share, and then it breaks down to about 15 cents. Now looking forward over here, Simply Safe Dividend, we say that it may be undervalued as well. The dividend yield is higher than the 5-year average, as you can see. Looking down some of the information in here, return on investment capita, latest is about 16%, return on equity 39%. That's the last 12 months. Now if we go now to tip ranks, based on their analysis, they rated a strong buy. You can see 5 buys and 1 hold. Their stock target price is 44. Again, the time of this video is 35 with a 25% upside. You can see the high of 47, the average of 44, and the low of 36. Now if we look over here, you can see some of the analysis forecasts. So you can see a lot of them pretty bullish on the upside. You can see, but then there's some holds and stuff. But from what they're thinking about it, the upside is pretty good. You got 60% upside, 39% upside, 42, 41% upside. So these are the analysis in tip ranks. Now if we go to a little bit more in the stock analysis, you can see outperform, smart score, hedge funds holdings have increased. So if we go a little bit more, you can see hedge funds increased holdings by 1.6 shares last quarter, and then they're very positive based on 17 hedge funds in the recent quarter. Now let's take a look at bar chart. Based on their price target is about 59, the mean is 48, and then the low of 36. And then their analysis is pretty much a buy as well. Yeah, moderate buy the last 3 months, so you can see. And then breaking it down, 7 holds, 6 strong buy, 1 moderate buy. Switching now over to Stock Rover, looking at the risk and return, you can see the 1-year return is negative 33, which is worse than the S&P 500. And then you can look at some of the comparisons with the industry right here, so you can see profitability wise, gross margin, price to book was 4%, price to sales 1.5, and then you got your price to earnings, then your dividend yield, and all that stuff. All right, now switching along to simply Wall Street. Looking at the share price versus fair value, you can see fair value rates at about 60, current price is at 35. Calculations based on their discount cash flow model rates is at 41% undervalued. Now, if we look at the company overview, you can see a little bit more. Some of the rewards and the risk. Earnings have grown 8%, trading at 41%, trading at good value versus industry. And some of the risk, you can see earnings are forecast to decline by an average of 2% per year for the next 3 years. Debt is not well covered, unstable dividend track, and large one-off item impacting financial results. So those are just some of the key things that Simply Wall Street has on this company. So my take on this one, I think it's a very solid company. You know, I think if that's something you're looking at, maybe definitely do a little bit more research on it. But from what I see, it's a solid, good company to invest on. Whether or not I'm going to invest on it, you know, I'm not sure. Again, it doesn't fall into my type of portfolio. If I'm definitely going to get something like this, I think it would be just a small portion of my portfolio, no more than 5%. But if that's something, if you're interested in this kind of company, I think it's a pretty solid company in my opinion. All right. Thank you so much for watching, guys. Hope you like this video. Please do me a favor and hit that like button. There's also other videos out here too as well, so definitely go check it out if you can. As always, please remember, be safe out there, stay cool, keep investing, and I'll catch you guys on the next video. All right, take care. Aloha.